it seems that technicals are really not looking great right now with this huge stock rout globally. What, $11 trillion already wiped out or so? Are we set for a bounce back at this point? And how would you position to take advantage of this?
Morning. I mean, the markets has been haunted by various macro uncertainties, the Ukraine situation, Fed hike scares and things like that. So, these factors have been haunting the markets for months. And it all boils down to perhaps, the most important number that will be released tonight in the States, which is CPI. Well, we need two dots to form one line. So together with last month's high print, and let's see what this print looks like, and we can at least see whether inflation is trending in the near term, and that would probably make investors recalibrate for the next, perhaps, equilibrium, and then think about what next. But yes, I mean, from what we've read, a lot of the sentiment indicators, positioning, again, as reported in a lot of the programs, bearishness in the Chinese COVID situation, everything is so bearish. Technical or not, it may induce a bounce in the short term.
So, what about some of those most?
But I mean,
finish your thought.
Sorry, go ahead.
Yeah, go ahead.
No, I mean, the U.S. market, having closed down like 7-8% in just 2-3 days, that is actually a decent opportunity to buy a dip.
I was going to ask, I mean, other than just buying the dip and these potential technical bounce backs, what are some of those fundamental trades that you can play in the long term? We see still a lot of volatility in the markets. So what we're trying to position is something with a very strong fundamental catalyst. One being the reopening trades. As we know, developed economies are reopening in very good progress after the COVID situation being contained. And therefore, we have been building meaningful positions in reopening themes, including airlines, booking platforms, cruise, travel, leisure, and so on and so forth, both in the States and Europe. Really, we think this year would be an end to the pandemic, and people would start, normalizing the activities, and that is supported by very strong mobility numbers around the world, either to the workplace or on retail activities.
What do you do about emerging markets at the moment, both with respect to China but other EMs? Because you're even seeing that value trade, which is still holding up in developed markets, not so much across EMs.
Right. I mean, EM ex China, Brazil has a very great run because of commodities run up. I mean, on that count, we believe the commodity complex should hold firm, if not, see another strong rally. Because a supply situation will still take time to resolve itself, and I think, but the whole commodity EM complex would be very much affected by China, and the situation there is still quite very uncertain, and the expectation is it is unlikely to achieve its targeted GDP this year unless we see significant policy stimulus, which we are still waiting forever. So in a sense, we have been sort of shrinking our exposure in the EM China complex, given it's just very difficult and very challenging to predict policy stance there, and we give our risk allocation to the DMs.
You talk about one of the risks of the noise being too big to ignore for the wave of selling, and we see a lot of that happening right now. If you take a look at all these risks of inflation, of tighter liquidity conditions, of geopolitical risk, does that mean companies are going to need to overcompensate when it comes to how much better future earnings are going to have to be to impress this market?
No, you're right. Because at the moment, still decent earnings reports over the last quarter. CEOs are saying demand is still strong. They're able to pass on rising costs to consumers because demand is just very strong still. But it is not going to last forever. And we all know that the Fed is on a hiking path, depending on the steepness, but it's designed to slow down demand. So maybe 2, 3, 4 quarters out, companies are back to on their own feet in terms of managing the cost structures and perhaps slightly, plateauing of top line revenue sales.